Let's discuss global markets, bond market in the United States, equity markets, and the most recent US jobs report. I have very bad news for you today, but guess what? This is what's happening right now, and I'm going to do my best to describe this in a more detailed manner, but also we need to cover a lot of ground today. So we will sort of cover the highlights, and I will further discuss some of these main points in my separate videos that will be released over the weekend and early next week as well. So global markets are now facing a very dangerous mix of economic and geopolitical pressure. Stocks are falling, oil prices are surging, bond markets are swinging wildly, and investors are increasingly worried that the global economy could be heading into a very, very difficult and challenging new phase, which we know it is. The question is just how bad is this going to be? To make things far worse, on March 26, on Friday, a weak U.S. jobs report added more fuel to the fire, just as a widening U.S.-Israel war of aggression on Iran is driving energy prices higher and reigniting fears of inflation. Together, these forces are creating a very volatile environment that is leaving everyone uncertain about what comes next. Nobody knows. Let's start with equity markets, and then we will move on to bond markets, the U.S. jobs report, where we'll discuss energy prices and several other things that are very important, in my opinion, in this context. So we're starting with equity markets. Equity markets have already begun to feel the impact. The S&P 500 dropped about 1.7%, putting the market on track for its worst week since October. Concerns about the private credit industry, and there's going to be an entire video about the private credit bubble that has to do with BlackRock limiting withdrawals from its massive private credit fund. That video will be released over the weekend, so definitely tune in if you're interested. But without a doubt, this step, the limiting of withdrawals by BlackRock from its private credit fund, that step actually raised questions about liquidity in the financial system. At the same time, oil prices are surging. Brent crude climbed above $90 per barrel as the war in the Middle East continues to disrupt global energy markets. This war that involves the United States and Israel that attacked Iran has created fears of a broader energy supply crisis, especially as energy exporters struggle to move shipments out of the Persian Gulf. Several refineries around the world began to cut output. We know that Qatar has already reduced and halted its output of LNG. Energy traders are increasingly concerned that supply disruptions are likely to persist, which would, of course, push fuel costs even higher and feed it directly into inflation. Next, let's discuss the timing of this energy cost rising, because this is really the worst case scenario for the United States. I have been warning about this for a long time now, so I don't think that any of my regular viewers would be surprised, but the timing of this energy shock could not be worse for the United States economy due to its cooling labor market. A new labor report showed that job growth slowed sharply last month. Non-farm payrolls fell by 92,000 jobs, which is one of the largest declines since the pandemic era. The unemployment rate also ticked higher, rising to 4.4%. The labor market continues to weaken, in other words, and as inflation fears rise, and those inflation fears are, of course, fueled by the U.S.-Israel war on Iran. So as we see those two forces sort of go in the opposite directions, the labor market is weakening and inflation is rising, this starts to sound a lot like a stagflation or depression that is in the making. Now, what does this mean for the Federal Reserve? Because that's the big unknown. What is the Federal Reserve going to do now? This combination of slowing job growth and rising inflation risks putting the Federal Reserve in an even more difficult position. On one hand, A weakening labor market would strengthen the case for the interest rate cuts to support economic activity, of course. But then on the other hand, the surge in oil prices threatens to push inflation higher again. And those two things cannot coexist. That leaves policymakers facing a dilemma as the United States economy continues to slow, while President Trump continues to push for lower interest rates. Some economists say that the central bank may now be caught between conflicting pressures, and of course that's exactly what's happening. If the labor market continues to weaken, the Fed will feel pressure to support the economy with lower borrowing costs. But if energy prices remain elevated, which of course they will, and that's because of the U.S.-Israel war of choice on Iran and the impact that it has on energy markets, inflation will resurge again. So in turn, this would encourage the Fed to maintain its restrictive policy position. In other words, the central bank may have fewer options than it did just a few months ago as a result of the war on Iran. And I want to be very clear. Because somebody has to be held accountable for this. You know, this is the result of policy choices. And we have to be very clear as to what's driving these quite discouraging developments in the U.S. economy. Next, let's quickly discuss bond markets. Bond markets are already reacting to this uncertainty. Treasury yields have been moving sharply as traders try to interpret what the latest data means for monetary policy. The benchmark 10-year Treasury yield climbed to around 4.16%, which is the highest level in several weeks. Meanwhile, short-term, the 2-year Treasury yield, which tends to track expectations for Federal Reserve policy, moved higher as well. So here, too, we see signs that inflation will remain high. The rise in bond yields reflects growing concern that inflation could remain stubbornly high. Of course it will, because energy prices are rising. Some traders have been expecting the Federal Reserve to begin cutting interest rates aggressively later this year, but those expectations are now being scaled back. Markets at this time, markets are currently pricing in about 41 basis points of rate cuts by the end of this year, which is down from around 61 basis points just a week earlier. Adding to the pressure on global energy markets is a surprising move by China. According to reports, Beijing has instructed its largest oil refineries to halt exports of diesel and gasoline as tensions escalate in the Persian Gulf. That decision has tightened global fuel supplies even further and helped push oil prices higher. The announcement also sent a signal that governments around the world may begin prioritizing domestic energy security as geopolitical risks continue to increase. Needless to say, rising energy costs act like an additional tax on consumers. When oil prices climb sharply, gasoline becomes more expensive, naturally transportation costs rise, and businesses face higher operating expenses. Those costs eventually ripple through the entire economy. So if you're sitting there thinking, well, this has nothing to do with me, I'm sorry, but that is not accurate. It has everything to do with you because we are consuming the products that are being imported into the United States, into the country where you live. And as energy prices rise globally, everybody's going to be impacted. Even modest increases in energy prices can reduce consumer spending and slow economic growth even further. So to sum this up, I know I covered a lot of information and I tried to do this in a very brief fashion, but to sum this up, it is crystal clear that the global economy is now entering a period where geopolitical events play a much larger role in shaping financial markets. Trump's war of choice on Iran has already begun to affect energy prices, inflation expectations, and interest rate forecasts. If the conflict continues to intensify, which it appears to be on pace to intensify, to escalate, its economic consequences could be quite brutal. In the United States, with a weakening labor market, things are not looking good. You can't hide the fact that the US economy is slowing. You can't have rising inflation and weakening labor market and continue to pretend for long that the economy is the strongest it's ever been. With midterms coming up, things are definitely getting very, very interesting, to say the least. Let us know whether you see energy prices rise where you are. We would absolutely love to hear from you, engage with other viewers, and let's build a community here. If you found this video interesting, please be sure to check out more content on my Substack and Patreon. Like, subscribe, and share on YouTube. And as always, I look forward to seeing you here tomorrow. Bye for now.